Dividend stocks can be great investments to hold inside of a tax-free savings account. They generate a lot of recurring income, and if a company raises its dividend, then that's even more cash flow you're collecting just by doing nothing. Today, I'm going to talk about one high-yielding TSX stock that recently raised its dividend, but also why you should be careful when looking at dividend growth stocks, because it can sometimes not be as attractive as they seem. Last month, utility company Emera announced it would be increasing its dividend. From a quarterly dividend of 72.5 cents to 73.25 cents, the company has announced an increase of 1% from what it was paying previously. With the increase, investors will now collect $2.93 in dividends per share. Based on the stock's current price of around $67, that translates into a yield of a little under 4.4%. It's a good yield, and it's one that's well above average. By comparison, the S&P 500 yields around 1.2%. This was also the 19th straight year that the company has raised its dividend, making it one of the more prominent dividend growth stocks on the TSX. There are longer streaks out there, but a 19-year streak is still a great accomplishment. The company projects that it will be able to grow its earnings by between 5 to 7% on average through to 2027, which is good news as it suggests that it may be able to continue to grow its dividend in the near future. Emera makes her a fairly stable investment to hang on to as it operates electrical and natural gas utilities in Canada, the US, and Caribbean. It serves 2.5 million customers and has $39 billion in assets, and it's still growing. The company's 5-year capital plan calls for $20 billion in capital spending through to 2029 as it looks to modernize and decarbonize energy delivery. The stability is evident in the stock's low beta value of around 0.4, which means that it generally doesn't move all that much in relation to the overall markets. This year, it's up 24%, but that's not been typical for the stock, and this latest rally is really a recovery from a downturn in previous years. On a 5-year basis, the stock is up just 20%, so maybe a bit disappointing when you look at the bigger picture. If your priority is dividends, however, it can be an attractive option due to its high yield. But just how safe is that dividend? If we look at the stock's earnings per share over the past year, they total $2.95, which is only a couple cents higher than the rate of its current annual dividend, $2.93. There's virtually no buffer there, as it's paying nearly all of its earnings out as dividends. Meanwhile, its free cash flow, which is what it has left after capital expenditures, is a negative $1.3 billion over the past 12 months. That also doesn't look great. And a big thing to watch for with dividend growth stocks, especially those that boast about their streaks, is to look at their trends and how much they have been increasing their dividend payments by. Emera's most recent increase was just 1%, and last year it also increased it by 1% from 71.75 cents to 72.5 cents. Prior to that, the increase was a bit stronger, coming in at nearly 4%, as Emera raised its payout by a little over 2 cents, from 69 cents to 71.75 cents. If you go back 5 years to November 2020, when it was paying 63.75 cents, that means the company has increased its dividend by 15% in 5 years, which averages out to a compounded annual growth rate of 2.8% per year. It's a decent rate of increase, but it's not all that impressive given how high inflation has been in recent years. And that's the important thing to watch out for with dividend growth stocks. They're often focused on keeping their streaks going for the sake of extending them. If Emera didn't have a streak, I wonder if it would still be compelled to increase its dividend by 1%. I would guess probably not, given how tight its payout ratio is. A better move may have been to wait for the earnings to grow and then to raise the dividend. But investors and analysts like streaks, and heaven forbid the company doesn't raise its payout consistently. I've seen this with other dividend growth stocks in the past, where they make nominal increases to their payout, all for the sake of keeping the streak going. Remember Walgreens, the pharmacy retail that had a dividend streak that was getting close to 50 years? It wasn't sustainable, its earnings were horrible, but it kept the streak going. Eventually, the dividend was not just cut, but entirely suspended. I'm not saying Emera is as bad as Walgreens, but it's an important reminder that when looking at dividend growth stocks, to consider their payout ratios, consider their rates of increases. The fact that Emera has raised its dividend by just 1% in each of the past 2 years now suggests that it's just doing it for the sake of the streak. Emera looks like a dependable dividend stock. Many utility stocks often are. But don't get fooled by a long streak into thinking that a dividend stock is a good buy because it's been raising its payout for years. If those increases are minimal, that could be a concerning sign that management is more concerned about a streak rather than what's best for the business. What are your thoughts on Emera's stock? Do you think it's a good dividend stock to own, and are you putting it in your portfolio? Let me know in the comments. Thanks for watching, and please leave a like and subscribe for more videos.